Another day, another knowledge. Part 2. Journal entries are the primary way of recording financial transactions in accounting. Here's an overview of the process of making journal entries. Identify the transaction. The first step in making a journal entry is to identify the transaction that needs to be recorded. This could be a sale, a purchase, a payment, or any other financial transaction. Determine the accounts involved. Next, determine the accounts involved in the transaction. This includes the accounts that will be debited and credited. Determine the amounts. Determine the amount of the transaction that will be debited and credited to each account. This will depend on the nature of the transaction and the accounts involved. Record the entry. Once you have identified the transaction, accounts, and amounts, record the journal entry in the general journal. Each journal entry should include the date of the transaction, the accounts debited and credited, the amount of each entry, and a brief description of the transaction. Post the entry. After recording the journal entry, post it to the general ledger. This involves transferring the debit and credit amounts from the journal entry to the appropriate accounts in the ledger. Prepare financial statements. Finally, prepare financial statements such as the balance sheet, income statement, and cash flow statement. These statements provide an overview of the company's financial position and performance and are prepared using the information recorded in the journal entries and general ledger. It's important to note that journal entries must follow accounting principles and conventions, such as the double entry system, which requires that every transaction be recorded with both a debit and a credit entry of equal value. Accurate and timely journal entries are essential for maintaining accurate financial records and ensuring compliance with accounting regulations. Thanks for watching. Subscribe my channel.